For a consultant, credit management is a critical intersection between sales and distribution, SD, and financial accounting, FI. It ensures your client sells to customers who can pay, minimizing bad debt while optimizing sales revenue. In the modern SAP landscape, there are two distinct areas of credit management you must master. 1. Classic Credit Management, ECC. Tightly integrated within SD or FI, Transaction FD32. 2. SAP Credit Management, FSCM, in S or HANA, the mandatory advanced engine that replaces classic credit management. This guide covers both, with a strong focus on the configuration and logic required for expert-level implementation. Part 1. Architecture and Fundamentals. 1. The core concept. Credit management acts as a gatekeeper in the order-to-cash (O2C) cycle. It evaluates sales documents against a customer's credit limit and risk profile. If the check fails, the system blocks the document, preventing further processing. Example: delivery or goods issue until released. 2. Organizational structure. Credit Control Area, CCA. The highest organizational unit in credit management. It monitors the credit limits of customers. Relationship to company code. One or more company codes are assigned to one credit control area. This allows for centralized credit management across multiple legal entities. Relationship to sales area. The sales area, sales org, or DIS channel or division is assigned to a credit control area. Greater than consultant tip. In complex rollouts, clients often ask whether to have one global CCA or regional CCAs. Greater than global CCA. Useful if customer A has a global limit shared across US and EU entities. Greater than regional CCA. Useful if the US arm and EU arm manage risk independently. Greater than. Part 2. Classic Credit Management, ECC focus. Even if you are moving to S or 4 HANA, you must understand Classic Credit to support legacy systems or manage migrations. 1. Master Data, FD32. In ECC, the credit master record is maintained via transaction FD32. It consists of general data, address, central data, total limit across all control areas, credit control area data, specific to one CCA, credit limit, the max exposure allowed, risk category, classifies the customer, example, high risk, low risk. This is the key driver for which checks are performed, reputation or block, hard blocks on the customer. 2. Configuration steps, SPRO, path, SPRO, enterprise structure, definition, financial accounting, define credit control area. A. Define credit control area. You define the currency and the update group. Update Group 12, the industry standard. It updates credit exposure at sales order, delivery, and billing levels. Update Group 15, updates only upon delivery or billing, rarely used. Path, SPRO, sales and distribution, basic functions, credit management and risk management. B. Assign credit control area to sales area. This is the link that triggers credit checking for SD transactions. If a sales area is not assigned to a CCA, no checks occur. C. Define automatic credit control, the brain. This is where the logic lives. You configure checks based on a combination of credit control area, risk category from customer master, credit group, document type classifier, example, O1 for order, O2 for delivery. Types of checks, 1. Static check, formula, open orders, plus open deliveries, plus open billing, plus open items, greater than credit limit. Pro, simple. Con, doesn't consider the time horizon. A customer placing an order for delivery in 6 months is blocked today. 2. Dynamic check, formula, open items, plus open deliveries, plus open billing, plus open orders within horizon, greater than credit limit. Horizon, a time period, example, 2 months. Orders due beyond this horizon are ignored. Pro, more realistic, allows taking future orders without blocking current capacity. 3. Oldest open item, blocks if the customer has any invoice overdue by more than X days. 4. Max document value, blocks if a single order exceeds a specific value, regardless of total limit. 5. Critical fields, blocks if credit-sensitive fields, like payment terms, are changed in the order. 3. Item categories and credit active. Not every line item checks credit. You must go to the item category definition, VOV7, and ensure the credit active flag is checked. Example, standard item, TAN, equals checked. Free of charge, TAN, equals unchecked. Part 3, SAPFSCM Credit Management, S or 4 HANA Focus. In S or 4 HANA, Transaction FD32 is obsolete. Credit management is moved to the Financial Supply Chain Management, FSCM, module. This is a mandatory simplification item. 1. Architecture changes. KVKK table is gone. Data is now in UKM tables. Business partner, BP. The customer master is replaced by the BP. Credit data is maintained in role UKM 000. WSRM, Web Service Reliable Messaging. S or 4 HANA uses internal XML interfaces to talk between the SD component and the FSCM component, even if they are on the same box. 2. Master Data Transaction BP. To maintain credit in S or 4 HANA, 1. Go to Transaction BP. 2. Select role UKM 000 SAP Credit Management. 3. General Data tab, define the score, creditworthiness, and risk class. 4. Credit Segment tab. This replaces the credit control area data. You assign limits here. 3. The credit segment. In FSCM, we map credit control areas to credit segments. Main credit segment, 0000. Equivalent to the central data in ECC. Subsegments. These represent the operational credit control areas. 4. Configuration, the rule engine. FSCM introduces a formula-based rule engine that is far more powerful than ECC's static configuration. Path, SPIR-O, Financial Supply Chain Management, Credit Risk Monitoring. A. Scoring and credit limit calculation. You can define formulas to automatically calculate a limit based on external rating, Dun and Bradstreet, etc. Payment history, internal data. Financial ratios. Example formula. $$ limit equals turnover times text, internal score factor, or text risk adjustment $. B. Checking rules. This replaces the automatic credit control in ECC. You define a check rule example. 01 dynamic check with 60 days. You assign this check rule to the business partner, not strictly by risk category anymore, though risk class still influences it. 5. Integration with SD, body, and implementations. In S or 4 HANA, the connection relies on body, UKMR3, ACTI VATE. You must activate this BADI implementation to ensure the SD sales order calls the FSCM credit check. If this is inactive, the sales order will save without triggering a check, even if configuration is correct. Part 4. The credit check process flow, step by step. To be an expert, you must be able to trace the life of a credit check. 1. Sales order entry, VA01. 1. User enters customer and material. 2. System determines the credit control area via sales area assignment. 3. System checks the item category. Is it credit active? 4. System determines the credit group, 01 for order. 5. Trigger. The system calls the credit engine, ECC, or FSCM. 6. Calculation. System sums up open orders, deliveries, billing, and AR. Adds the current order value. 7. Comparison. Exposure versus limit. 8. Result. Pass. Order saved. Status is approved. Fail. Order saved. But credit status, VBUK CMGST, set to be blocked. A delivery block is usually applied automatically. 2. Delivery creation, VL01N. 1. User attempts to create delivery. 2. System checks credit group, O2 for delivery. 3. Recheck. The system checks credit again. Why? Because between order and delivery, the customer's credit situation might have worsened. Example: a check bounced. Or the delivery quantity might be higher than the order quantity. Over delivery. 4. Block. If check fails, PGI, post-goods issue, is prevented. 3. Post-goods issue, PGI. At PGI, the value moves from open delivery exposure to open billing exposure. The total exposure remains roughly the same, but the category of exposure changes. 4. Billing, VF01. When the invoice is posted to accounting, the value moves from open billing to open items, AR. The credit exposure is finally reduced only when the customer pays the invoice, clearing in VI. Part 5. Expert troubleshooting and tables. A consultant is defined by how they debug issues. 1. Key tables. ECC. KNKK. Customer Master Credit Control Area Data. Limits. Receivables. Special LIAB. Crucial Field. SKFOR. Total Receivables. KNKA. Central Credit Data. Total Limit across all areas. S066. Open Order Values. Info Structure. Common Source of Data Corruption. S067. Open Delivery or Billing Values. VBUK. Header Status. Field CMGST. Credit Status. A equals pass. B equals fail. D equals released. 2. Key tables. S or 4. HANA. FSCM. UK. MBPCM. SSGM. Credit segment data. Limits. Utilization. UK. MITEM. Individual credit exposure line items. Replaces S066 or S067. This is much more granular and auditable. 3. Common issues and fixes. Issue 1. Credit limit exceeded, even when the customer has paid. Cause: the credit exposure tables, S066 or S067, are out of sync with reality. This happens often in ECC due to aborts during update tasks. Fix: ECC, run report RVK RED77, reorganize credit data. Warning: run this when the system is quiet, it locks tables. Fix: S or 4 HANA. Run report UK MCOMMIT SRE BUILD. Issue 2. Order is blocked, but user increased the limit. Order still blocked. Cause: changing the master data does not automatically unblock old documents. Fix: run transaction VKM3, sales document release. The credit manager reviews blocked orders and releases them manually. Releasing triggers a new check against the new limit. Issue 3. Update group confusion. Scenario: client says, "Why is my credit exposure increasing at delivery, not order?" Check: verify the assigned update group in OBA7 or OB45 settings. Ensure the credit group for sales order, O1, is actually activated in the automatic credit control. Part 6. Important gotchas for consultants. 1. Tax and credit. Does the credit check include tax? Usually yes. The customer must pay the gross amount, so the risk is the gross amount. Ensure your pricing procedure. Subtotal A, credit price, is assigned to the net value plus tax, or just net value if legally required otherwise. 2. Special G or L indicators. Does a down payment request count as exposure? In configuration, you must explicitly select which special G or L indicators, down payments, security deposits, are included in the credit calculation. Seasonality. Some businesses need higher limits in Christmas. Solution: in ECC, this is manual. In FSCM, you can use formulas to auto-adjust limits based on the month, or upload temporary limits valid only for a specific date range. Part 7. Migration to S or 4HANA, the hot topic. If you are on a project moving from ECC to S or 4HANA, you will lead the credit migration. 1. Prerequisite: Customer Vendor Integration, CVI, must be done to create business partners. 2. Configuration migration. SAP provides tools to migrate credit control settings, but FSCM rules often need to be built from scratch because the logic is different, formulas versus static checks. 3. Data migration. Use tool UKMM-ASSDSP to create credit relationships for BPs. Use UKMTRANSF-ERITEMS to pull open sales orders or invoices from SD or FI into the FSCM tables. Summary checklist for the expert. Can you explain the difference between static and dynamic checks? Do you know how to rebuild credit structures? RVKRED77. Can you navigate VKM3 to release an order? Do you understand the relationship between credit control area and company code? Can you configure the reaction, warning versus error versus delivery block? Mastering these specifics moves you from a transaction user to a solution architect in the credit management space.